Yeah, there's still a couple of people trickling in. As usual, we're following a similar format today. We're going to go through just one or two quick slides in terms of contextualizing market performance over what's been an exceptionally volatile first half of 2026. And then we'll dive into portfolio performance and then really spend a lot of the time unpacking some of our themes for the rest of the year looking forward from this point. And I'm sure we're seeing very, very large moves and certainly some uncertainty and some concern with some of the themes that have been going on, not only from the Middle East perspective, but what's been happening with the memory trade and the broader AI trade. But let me share my screen and jump right into this. We've got quite a few slides today as well, so I'm going to go through some of them pretty quickly. Please feel free to post any comments as I'm going through the slides. I'm going to try and leave 5 to 10 minutes at the end if we can get through this pretty quickly to answer any questions that you may have. And if you do pop questions and I don't answer them, don't worry, we'll definitely make sure that we get back to you following this webinar. Okay, so I think when we chatted the last time at the end of Q1, there was a lot of uncertainty in terms of what was happening in the Middle East, what was going to happen to oil prices. I think we had made the point that typically history shows you that it's always pretty good to fade most geopolitical risk, because when you kind of come and step forward over the next 12 months, typically the impact of that is almost forgotten. Now, what's interesting here, this chart has been cut off as at the end of June, and we can see how oil pretty much round tripped over to the end of June, given the steep sell-off that we saw and the rise in oil prices during March and sort of uncertainty in April. And all kind of seemed calm at the end of June, but obviously we've seen an uptick in some of that conflict, and we've seen oil and Brent crude tick quite quickly back up to 90. So there are a lot of questions around sort of the broader inflationary impact of that. But I think something that was pretty interesting, and it's really important to consider if you have a large allocation to broader South African assets, is that in the back end of last year, we saw this parabolic move up in gold, and we're kind of cautioned, you know what, when you see something go from bottom left to top right over a very short space of time, kind of as market participants, we're often pretty hesitant in terms of how quickly that might retrace. And we saw some of the precious metal moves start to crack end of Jan and into Feb. And certainly in March, the move higher in bond yields as a result of inflationary concerns was a justification for precious metals losing some of their shine and selling off. But the interesting thing, as we saw bond yields start moderating throughout the rest of the second quarter, as well as energy prices moderate, we've seen gold continue to sell off. And that sort of parabolic move that we saw continues to unwind despite some of that those declining energy prices. And that obviously has a big knock-on impact for broader South African assets, which we'll dive into. And here you can see, so quite interestingly, we've seen, this is kind of just looking back over the last 12 months, your broad South African asset classes, SA equity, SA property, SA bonds, ILBs, and cash. I mean, the first thing that stands out, and that was very much baked into the first 6 months of this period, so the last half of 2025, was that there was exceptionally strong growth asset return across pretty much all asset classes in South Africa, as we saw that parabolic move up in gold and precious metals. And really what we've seen from a South African equity perspective is that continued moderation, tracking pretty much the broader precious metals prices lower. We've had a bit of a rebound in SA fixed income from the lows at the end of March, but really broadly kind of a balanced South African only portfolio would have gone really nowhere over the last kind of 3 months. So really, kind of the precious metals losing their shine is an important, really important consideration for broader South African assets. But you know what? We're not only in a South African-only portfolio. We are, and most South African Reg 28 balance funds are well diversified globally. So kind of the baton of return drivers from precious metals for SA assets was pretty much handed over to global equity exposure. And what's quite interesting is that it wasn't the usual source of strong global equity returns that we've seen over the last 5 years, 10 years. Actually, kind of that MAG 7 cohort has been lagging the broader markets. Here we've kind of benchmarked these different equity indices returns in Rand on a year-to-date basis. And what you can see, it was all about the memory trade in Q2. So the hyperscalers spending a lot in terms of the AI build out and supply bottlenecks around memory and semiconductors really benefiting from that. So the one expression of that is the SOX index. So that's a Philadelphia Semiconductor Index. That's the sort of the royal blue. You can see from about 100 at the end of March, it rallied pretty much up close to almost 200. So almost at 100% towards the end of June. And then through July, we've seen a little bit of a moderation of that trade. Similarly, Korea, we know SK Hynix, Samsung, basically Korea is made up of pretty much those two shares, track that same supply constraint trade. And the interesting thing is actually EM equities benefited a lot more than developed market equities as a result of this, given some of those compositional changes. So really, over Q2, a higher allocation to emerging markets or directly to the semiconductor complex would have supported performance. So when you kind of put it all together, even though you've had a big detraction from SA equity and the gold trade, kind of your offshore exposure helped the portfolio somewhat. So if we try kind of consolidate what's happened here just across the broad asset classes, we like to think about it through growth versus defensive asset class splits. On the left-hand side, you've got all of your growth assets. And what you can see is when you benchmark 1 year performance to the end of June, really most asset classes, barring global bonds and cash, delivered sizable inflation-beating returns. Some very high, like emerging market equities. SA property up 30%. Even SA equity, despite the soft first 6 months of 2026, delivered 18% to the end of June. And SA equity was actually beaten by both SA bonds and inflation linkers. So over the last 12 months, clients should be sitting relatively happy with pretty sizable inflation-beating returns. The picture obviously has changed somewhat over the first 6 months of this year. You can see SA equity being a laggard both on a year-to-date and a 3-month quarter-to-last second quarter basis. The fixed income complex, as well as SA property, which is pretty geared to interest rates, we saw rallied really over the last 3 months as some of the energy concerns reduced with the falling oil price. And it's really been emerging market equities over the last 3 months that has been a standout. In spite of that, though, DM equity also up about 10% has been pretty strong. And really, it's those kind of global diversifiers, global bonds and cash, which have been pretty much a headwind to return over the last 12 months and on a year-to-date basis as well, given that the Rand has actually been relatively resilient in the face of some of the risks that we've seen. So what does that mean for our performance? Well, we've been somewhat more defensively positioned over the last sort of 12 to 18 months, and that's kind of coming through in the 1 year number. What we have seen on a year-to-date basis is that a broader portfolio performance has actually been pretty much flat across the broader balanced fund universe and category. Our somewhat more defensive positioning is actually coming through there, outperforming the peer group on a year-to-date basis, but there's a little bit of ground to gain given the more broader conservative positioning with allocations to global bonds and cash, which has taken some of the shine off over the last 12 months. We'll get a little bit more into positioning and the outlook going forward. So for the rest of the session, we're going to kind of split into three areas. We're going to touch on briefly some South African market themes, very much commodity focused as well, and some of the impact in terms of kind of the push and pull between oil and precious metals. And then we're going to spend most of our time with an update on a global view, primarily around what is pretty much the biggest theme now in terms of the AI build-out, what that means in terms of expectations that are baked into markets, and how to think about positioning portfolios for where you're being paid for taking risk. Remember, we're not in the game of trying to call markets over a 3 or a 6 month basis. We like to understand what assumptions are baked into where markets are pricing today, and then allocate capital so that we improve the probability of our clients meeting their investment objectives over the coming horizon. So for us, it's really about understanding where we're being paid for taking risk rather than forecasting what's going to be happening in the markets over the next 3 to 6 months. Having said that, what's quite interesting is to look at what's happening with South Africa's trade balance. We know commodities are our main export. That basket's made up of precious metals, primarily gold and PGMs, as well as iron ore and coal. Biggest import is refined product and oils. And those are, along with vehicles in terms of exports, are the main drivers of our trade balance. Now, what we've done here is we've just kind of plotted metals and the oil impact, and we've done it on a 3-month moving average basis because a month-to-month can be very, very noisy. And what you can see is, given the rally in gold and precious metals, that the hard currency that we're earning for our exports, certainly on a 3-month rolling average basis, ticked up pretty high throughout 2025 and sort of continued in the beginning of 2026. And then you can see that big spike up in oil in terms of our trade balance, which has brought down our trade balance. Now, the blue line, which is the 3-month, dark blue line, which is the 3-month moving average, is still positive. But what was quite interesting is that May gave us our first negative, so our first trade deficit since January 2025. So we're certainly seeing from an external environment, what's been a fantastic 18 to 24 months is starting to turn somewhat, given the big push up in oil, as well as the softening in precious metals. And what that really means for us is we had a bit of a safety net, given this really positive trade balance, which meant that we weren't really that reliant on foreign capital flows to support the rand. But as we see a softening in the external environment, which moves us into a trade deficit, it just creates increased risk around how we ultimately are going to drive a surplus in our broader current account, and how we're going to obviously finance our broader fiscal deficit, being pretty more reliant on portfolio flows. And that's been pretty positive, certainly on the fixed income and the bond side. We've seen a strong demand for emerging market local currency debt, which has seen foreigners pile into our bond market again over the last 12 months. So nothing to really be alarmed about, but just to note that there's an increasing risk around SA and SA assets due to the change in the external environment. Now, what's quite interesting, and I mean, today we had an inflation print at 5%. I think consensus was at 4.5%. So we saw really inflation running away from expectation, and certainly far away from the Reserve Bank's new target, which is kind of that range around 3 up with an upper limit to about 4%. Now, the one question here is, if you think about how the South African economy has evolved, how we've moved off rail and our rail network has pretty much almost collapsed, and there's some improvements around that, but still most of our freight is on road and reliant on diesel. What the chart on the left shows you is, even though Brent crude, so oil, really reduced quite materially in the second quarter. You've got to sort of squint your eyes there a little bit, the far right hand side of the chart on the left. Brent crude dropped significantly, but diesel, or the refined product, still stayed pretty elevated. And if you think about what the input to inflation is, it's not actually Brent crude. We know we've had a number of closures around our own oil refineries. We actually need to import the refined product. So the price of the refined product is pretty important. And what the chart on the right-hand side shows you is just the difference between the purple line and the blue line. It's called a crack spread. It's basically the refining margin. And what you can see here is that the diesel refining margin is at the highest level that it's been on record. And that means that even though oil subsided a bit, the broader inflation risk that's being pushed into the South African economy is still somewhat elevated. And that becomes a challenge, of course, with the Reserve Bank moving to the new 3% inflation target. I think it's pretty much a done deal that they're going to be hiking interest rates by 25 points tomorrow. Market certainly pricing that as well. But it's going to be interesting to kind of read through more as we get inflation that's surprised to the upside, the reaction function from the Reserve Bank. How aggressively are they going to hike interest rates to anchor inflation expectations down closer to their 3% target, when the main driver of actual realized inflation is those input prices that they have no control over. So the risk around that is obviously that we see higher real rates as a result of them trying to anchor inflation expectations. What you're seeing here on the chart is basically break-even inflation at the 5-year point, the 10-year point, and the 20-year point of the curve. And what that's telling you is that the market is kind of buying the central bank's credibility, and the market pricing of inflation risk is very contained. If I had to say at the shorter end of the curve, the 5-year point, what you can see is that darker blue line, you could say, well, that's kind of roughly pricing on kind of average. And of course, it's a lot more sensitive to realized inflation because there's much lower duration. But what you can see is as you step out of the longer end of the nominal bond curve, the 10-year, the 20-year point, that long end of the nominal bond curve basically almost has really no additional inflation risk premium for the uncertainty around where inflation will sit. So from a market pricing perspective, the market's certainly pricing that inflation is going to remain well anchored at the long end of the South African bond curve. The risk, of course, is that if we continue to see elevated inflation levels coming through, that might see our nominal bond curve re-steepen somewhat as well. Certainly, if history is anything to anchor on there. In spite of that, we're still seeing real rates in South Africa above 4%. If we see a strong reaction function from the Reserve Bank, we could see those real rates tick back up closer to 4.5%, 5%. Regardless, though, we're in that elevated territory where we've been pretty much since 2020. Now, that means two things. One, for investors who are worried about hitting certain inflation-beating returns, it offers a really low-risk way to do that. You can kind of clip your inflation plus 4, inflation plus 4.5, which is pretty much in line with what long-run return expectations are for a balanced fund and a balanced portfolio. So it's a very low-risk way of delivering those investment outcomes. But on the other hand, it also creates quite a restrictive and a high interest rate hurdle, which is obviously a big headwind for broader economic growth. If you think about it from a corporate perspective, your cost of capital is elevated. Well, your hurdle rate for investing in new projects is obviously pretty elevated. So generally, what do? Well, you probably go own some of those inflation-linked bonds rather than invest in building out the broader economy and your business. So that those elevated real rates still kind of maintain quite that high cost of capital. Now, it's quite interesting. Throughout last year, we saw a bit of that positive virtuous cycle that led to falling interest rates, a stronger rand, the Reserve Bank cutting interest rates. And that positive virtuous cycle has almost pretty much been put in reverse in terms of how the external environment has changed, with precious metals weakening and oil really strengthening pretty much somewhat. Now, what that means when you think about contrasting on a cross-asset basis, when you think about equities versus bonds, that high real rate really compresses an equity risk premium. And what we can see here is certainly in that environment where we've had pretty elevated real rates, that equity risk premium has been pretty compressed. And given the sell-off in equities that we've seen over the 6 months year to date, we've seen a little bit of a retracement in that, but kind of sitting at about sort of 2% real. There's really not that much additional return on offer from South African equities, given the range of outcomes from the asset class on a forward-looking basis when you compare that to bonds. So really still restrictive real rates from a South African perspective. Now, I think this is something we all inherently know, but it's probably worth just appreciating how that has evolved over the last couple of months. Now, what we're looking at here is rolling 24-month correlations between South African equity and gold and South African equity and South African bonds. When we think about building a portfolio and we think about portfolio construction, correlations are obviously important, because if an asset is negatively correlated or has very low correlation, you're able to build a portfolio of different return sources that can offset each other and help deliver a slightly smoother ride. We spent a lot of time in some of the previous webinars unpacking around how the shape of SA equity has changed, how we've got about 30% sitting in gold and platinum miners, just of a broad SA equity index. And you can see that coming through in when you look at it through sort of like a risk factor lens, and you see those correlations. That blue line shows you that over the last 24 months, SA equity and gold has been correlated kind of over 0.8. So kind of really, really strong correlation. Gold up, SA equities up. Gold down, SA equities down. What you can see is actually it's pretty much the highest level that it's been going all the way back to the mid-2000s. And that's been fantastic on the way up, right? Those correlations pulled together when the asset class was going up, because that's not really when you worry about diversification. But at the point where we sit now, where those correlations are really high and really elevated, one needs to think about how we drive diversification in the portfolio if we see a continuation of the moderation that we've seen over the last 6 months in terms of gold and precious metals. I mean, we're only back to sort of where we were in September last year for context there in the gold price. Now, that's SA equity and gold. The interesting thing is at the same time, we're seeing the highest correlation levels between SA equities and bonds, kind of the growth and the defensive asset in SA. Again, super important, right? Now, what you can see is pretty much since 2020, SA equities and SA bonds have been pretty positively correlated. That makes sense. We were downgraded to sub-investment grade in kind of around COVID. High, that makes a sub-investment grade. You kind of high yield or junk. High yield bonds are a growth asset class. You expect growth asset classes to be positively correlated with each other. That's what you're seeing from SA equities and SA bonds. But what you're seeing more recently is that correlation, again, sitting close to 0.8, is the highest that it's been going back over the last 25, 30 years. So if you're building a portfolio with SA equity and SA bonds as two large allocations, that's been fantastic in 2025. Fantastic when we look at 1-year returns over to the end of June 2026. But you need to think about how much of your portfolio is really a one-way bet, which is pretty much anchored almost on what's happening in precious metals. And it's not that simple, but if you kind of distill it down to sort of very high level, simple underlying drivers of risk and return, it's a big consideration that you need to think about, and it's something we're thinking about pretty concretely. So just wrapping up on the SA side of things, we're seeing that elevated refined product margins continue to create inflationary pressure. We saw inflation upside surprise today at 5% versus consensus at 4.5%. And until we see some sort of moderation in those refining margins, it's not actually really about what happens to Brent. It's really that input price in terms of petrol, in terms of diesel, which is the big driver here. We're seeing a waning trade balance given elevated oil prices and declining commodity prices. That's moving our trade balance into a deficit. You need to kind of keep an eye on our current account balance as well, and it just increases the reliance on foreign capital flows to support the broader rand going forward. We're certainly seeing limited compensation for inflation uncertainty at the longer end of the nominal bond curve. So what we're effectively doing is we're running a much shorter duration in our bond exposures, both in terms of nominal and inflation linked, because we're not seeing compensation for a risk that certainly does exist. I mean, the market's immediately gone and anchored on the SARB's sort of 3% target. We think there's uncertainty in terms of their ability to land that, given that inflation is very much driven from external factors. And really kind of needing to focus on diversification, given that SA bonds and SA equities are pretty highly correlated, and also driven really by that underlying precious metals and oil trade. So how are we thinking about that, shortening our duration on our bond exposure? We've also used explicit protection in the equity part of our portfolio, given that we allocate to broad market indices, which have a high concentration in precious metals. So that's everything from the South African market side. I'm going to flick forward into the global space and how we think about that part of our portfolio. Just to be clear, we don't think about it kind of individually. We think about the whole portfolio in totality, and we'll wrap that up with the end with our current positioning. Look, I think a lot of these slides will be well known to everyone here. Ad nauseum in terms of what's happening in terms of the CapEx cycle related to the AI build out. But it's worth just anchoring on those numbers again. Here, kind of taken the 5 big CapEx spenders. So that's Microsoft, Amazon, Meta, Google, Oracle. And what you can see is that there's really no stepping back from capital expenditure, despite obviously we spent a number of the previous webinars talking about concerns around ROI. We're certainly not seeing a pullback yet on spending coming through. And what I've done on the 3 right-hand bars shows you analysts' consensus CapEx forecasts for the next 3 quarters, so through Q2, Q3, and Q4 2026. And again, we see that all consensus expects this CapEx to continue, really moving these companies from pretty much capital-light businesses to capital-heavy, and that indication of a continuation of CapEx has what's really caused some challenges in the broader AI supply chains. And those bottlenecks have very much come through in terms of memory, DRAM, price index here. So actually memory is, even though it is something that's manufactured, it's almost like a commodity. It's almost like something like gold and platinum group metals that are mined, because it has a price index just like a commodity would. Its price is purely driven by supply and demand. And what you can see is pretty much over the last 12 months, the price of memory has gone up about 8 times, which has been pretty exponential, just because there's so much demand for memory in terms of the AI and data center build-outs required to provide compute for the AI trade, that actually kind of that supply-demand imbalance has just seen those memory prices absolutely explode. And that's really what's filtered into those really strong returns from the Korean market, from the Taiwan market, from the broader semiconductor complex, because they're able to kind of pass on those prices. So what you're seeing is that the significant uptick in investment isn't necessarily more data centers being built out. It's that the price and the cost to build those data centers is increasing materially, because the input prices are increasing quite materially. So what you can see is this is very much this tight link between the spending from the hyperscalers very much moving directly to the profit and the bottom line of the semiconductor and memory stocks. Now, the interesting thing about any sort of technology change that requires massive capex and massive investments to really unlock, and kind of technology and the internet in terms of the 2000 was a parallel, and we've gone through in other webinars many other parallels, electricity, railway, etc., all require this big upfront spend on capex, and typically they follow a path of building too much capacity, which then becomes a benefit to all the users, but necessarily those who have spent the money in terms of the capex don't always necessarily benefit. But if you think about what that does, is that like the build out around those bubbles are inherently inflationary because of some of those supply demand dynamics. So a lot's been made around how are we going to find enough electricity, how much electricity is going to be built to really power these data centers. In the US, you've got electricity CPI running above 4%, which is far away from the 2% inflation target, also much higher than kind of the realized inflation that's coming through there. And the blue line is very interesting. I mean, that is effectively semiconductor import prices into the US, which is a component of obviously the cost of these data center build-outs. And you can see how that has also gone exponential and pretty much tracked the increase in those memory prices. So everyone talks about how AI can be deflationary because of the productivity impact of it. But before there's any deflationary impact from a new technology, the actual build out to use that technology is pretty highly inflationary. And that's something that one needs to think about in terms of the broader sort of macro environment. You overlay what's happening in kind of energy and crude markets there, and there is certainly challenges around the broader inflation picture going forward. Now, this is something that has been very interesting and has kind of come to the fore, I would say, really throughout Q2. And that's really kind of this a move where kind of those spending, the Mag 7, really a lot of the hyperscalers, the majority, and I take that NVIDIA is also part of the Mag 7, so it's somewhat skewed, but certainly the hyperscalers have come under significant pressure as the people writing the checks for the AI build out. And it's really those who have been earning the checks, so the semis and the memory companies, that have really rallied pretty strongly. And what's quite interesting is through July, you see a reversal of that trade. You've seen the semiconductors companies, the memory companies, albeit off a really parabolic move, moderate quite a lot. And what you've seen is you've actually seen the hyperscalers and the Mag 7 actually rally quite significantly over the last 3 months. Last 3 weeks. And so what's quite interesting about that is you've got kind of two large parts of the market moving in opposite directions, the spenders and the earners, as there's a lot of uncertainty in terms of how this will ultimately play out going forward. What we do know is that up until now, these highly cash generative hyperscalers, so here again, we're looking at those 5 companies which are the spenders, have been able to fund most of that capex from their operating profit and their operating cash flow. But what we're seeing here is really the cash flow and operations are still forecast to continue increasing, although certainly not as fast as the increase in capex. And what we're seeing is net as a group, free cash flow is actually set to turn negative for this large group of Microsoft, Meta, Amazon, Oracle at the end of 2026. Now, that has a couple of important considerations. Firstly, these companies have been a large source of share buybacks, given their weight in the index, given how much cash flow they were just throwing off. They didn't know what to do, so they were buying back stock hand over fist. And what we're already seeing is kind of a bit of a step back in terms of the share buyback. But equally, that's not even enough to fund this CapEx investment. So we're seeing these companies come to market with actually fresh equity offerings, with significant debt offerings and debt issuance. And all of the significant capital raise makes these businesses a lot more cyclical, a lot more geared to the broader economic cycle. And it creates a potentially an operating leverage problem for these businesses if they aren't able to generate enough ROI from the CapEx spend going forward. No one knows how it's going to play out, but certainly the risks are much more elevated at this point. What's been happening in the memory market has actually seen the face of broad emerging markets evolve very rapidly, even just over the last 12 months. So kind of picked out a few. I mean, South Africa's here just out of interest. You can see, I think we're about 2.5% of the broad emerging market index. It shows you how small our market cap is in terms of a global context. But what you can see is if you look at those bottom two darker lines, Taiwan, South Korea, you can see how their weight in a broad emerging market index has actually gone really from about a year ago. They were sitting at about 25%. It's pretty much doubled to 50%. Just those two companies. And if you think about the fact that really 30% of a broad emerging market index is made up of TSMC, which is in Taiwan, SK Hynix and Samsung in South Korea, you can see that actually there's a lot of concentration that exists in a broad emerging market index. Done fantastically well to this point. But your emerging market of today is not your emerging market of 2020, where China absolutely dominated it. And it's not your emerging market of 15 years ago, which is pretty well diversified across a range of different markets. You can see that other bucket has gone from about 45% to around 20% now. So EM is very concentrated. Actually, it's a better expression of the AI trade than developed markets or even the US equity market, which again, I think flips on its head how we think about the traditional relationship. Tech has always been a DM trade, a US trade. No, now it's actually an emerging market trade. Here you can see, if you break down those underlying exposures, semi and semi-equipment, and then technology X semis, you can see Taiwan sitting above 80%, Korea's at 80%, broad emerging markets at close to 40%, actually just pipping up the US there as well. So broad index exposure, whether it's MSCI EM, whether it's MSCI DM, you're highly concentrated in tech exposure. It's been a fantastic tailwind up until this point. But you do need to think about how well you are embedding diversification across more than just a single theme, because what goes up in a parabolic manner often tends to come down in a similar type vein, as we saw certainly with gold, if we cast our mind back over the last 12 months. Now, this is something I found super interesting. Undoubtedly, many people are saying, well, look at the earnings, prices following the earnings, and the US and these, I've called it here the Mag 5, which are basically your hyperscalers, who are the spenders. They're generating fantastic profits. And if the earnings are that strong, there's really nothing to worry about. You can justify materially higher elevated valuations. Now, that is true. You can, but one needs to ask the question about how sustainable are the strong earnings that we see. And so what you're looking at here on this chart is basically taking the non-operating profit of those 5 companies as a percentage of the total S&P 500 net income. And what that shows you is that more than a third, about 35% of Q1 year-on-year earnings growth in the S&P 500 was the non-operating profit of these 5 businesses. And let's be clear what that non-operating profit is. It's the mark-to-market gains on their private market investments in terms of OpenAI, Anthropic, that's feeding through, SpaceX, that's coming through. Now, those are fantastic on the way up. And I wouldn't be surprised if we see this part of earnings growth in this coming earnings season be pretty strong as well. Because if you think what's happened more recently, you've had throughout the first half of the year, Anthropic moved from about a 250 billion valuation to kind of almost just under $1 trillion. So a good chance you're going to see strong earnings from non-operating income again, the investments in these private AI businesses. But the extent to which you can continue to realize those mark-to-market gains, or the extent to which those gains could potentially become losses. It's quite interesting to see how SpaceX has been performing now post its IPO. It's now below its IPO price, and a lot of the froth and a lot of the excessive valuations that are coming through are starting to be questioned. But if we strip that away, broader S&P 500 earnings growth is materially lower, and actually maybe valuations aren't that cheap on a forward basis. And I think this is something to really keep an eye on going forward. The other thing, of course, is to say, well, what are those expectations that are being baked into current prices? And so what this chart looks at, it looks at kind of long-term, so sort of 5 years out, analyst earnings expectations that would really justify and embed what prices are being paid today, or what would be realized as kind of an attractive valuation given growth. And what you can see is that the long-term earnings growth forecast for the technology sector is baked in at 40%. And that's just not sustainable. I mean, you can see how quickly it's been marked up. You can see what happened in the 2000s. And there is no example where a sector has consistently, over long-term time periods, earned 40% earnings growth year on year. So yes, maybe on a forward-looking basis, some forward valuation metrics appear the most attractive they've been in the last 5 years. But what are those assumptions that are baked into those forward expectations, and how reasonable are they? And from our perspective, we're really sitting at pretty stretched, unsustainable levels that haven't been repeated anywhere over the long term, going back in history in a sustainable long-term manner. The other thing that's pretty interesting has been this explosion of leverage that's coming in, specifically to the part of the market that's delivered really strong returns, so semis and tech. On the left-hand side, you can see a chart that just looks at the broader S&P 500 price index, and then it looks at the growth in margin debt over a year-to-year basis. And what you can see is that margin debt pretty much peaked, or almost at previous sell-offs. Going back through history, we had a point where there's significant margin debt that's coming through into the system. And over and above that, we're seeing these 2 times, 3 times levered ETFs that are just exploding. You've now got about 250 billion in terms of AUM around these leveraged ETFs that are coming through, that are certainly contributing to these really large price swings that we're seeing. I mean, if you look at Korea, it's up 5% in a day, down 10% the next day, up 8% the next day. These just aren't normal moves. So really being underpinned by a lot of leverage that's coming through in the system. And we've really seen how the story plays out over the longer term as well. I found this really, really fascinating. It might be a little bit geeky, but it just tells you and shows you the contrast between what's happening in some of the single stock moves and what's happening at the broad index level. Now, if you look at like the moves in the Mag 7 and the semiconductors in Korea, and then you have a look at like the index level move in terms of the S&P 500, it's pretty much been this very smooth, calm march up from bottom left to top right for the S&P 500, barring some of the geopolitical events that we've seen over the last couple of months. And why is that? Well, it's actually this kind of trade between the spenders selling off and the earners rallying, and then the spenders rallying and the earners selling off. And actually what you've got is that correlation at an index level is the lowest that it's been going back over a really long period of time. Actually, you can see it on the chart on the right-hand side. What we're seeing there along the bottom axis is the implied correlation over the next 1 month for the S&P 500. And actually, the point, as at the end of June, is the lowest that it's been going back over more than 10 years. Something like 12 years. So it started in 2014. And what you can see there is that the correlation is so low that it's creating and reducing volatility at an index level. But the ratio of single stock vol to index vol is also pretty much the widest that it's been. And that's what's being measured by the vertical axis. And you can see the difference between that on the chart on the left-hand side. So that the traditional VIX, which you'll know, so volatility implied vol for the broader S&P 500, still sits pretty well contained. But when you look at the implied volatility of the underlying single stocks, what you can see is that that is pretty much up at stress levels that's only been really preceded during kind of the COVID sell-off and the brief sell-off that we saw last year with the Trump tariffs. So really what is quite a calm surface is belying a lot of the really volatile moves happening underneath the surface. And what changes? Well, we know in a correction, correlations tend to 1. And in that environment is when you probably see the purple line and the blue line converge when those correlations start moving in the same way in terms of the underlying market structures. Cognizant of time, so I'm going to kind of flick through this quite quickly. Everyone's saying, well, not everyone, but a number of market participants are saying, well, we're just following fundamentals. We're going to keep track of earnings. When earnings start turning, that's when we're going to kind of get out of what we know is a bubble, but we need to participate anyway. This gives you kind of a bit of a parallel from 2000s, looking at the SOX index again here, semi and semi-equipment. And what you can see here is that the market peaked in March of 2000. Analyst earnings expectations and actual earnings as well. So not only forward earnings, but actual earnings continued increasing for an entire year following that market sell-off. Why? Well, the market prices in information much quicker and much more efficiently than analyst forecasts or analyst expectations. So if you're waiting for fundamentals to change to get you out of what you kind of believe or think is a bubble, well, it's going to be too late, because actually that's a lagging indicator from a market perspective. Other thing, again, just some parallels from the 2000 period. There were the telecom companies, which were almost like your hyperscalers at the time. They were the spenders. They were the guys financing the build out of that technology. And the communication equipment companies were the earners of that CapEx cycle, okay? And so what you can see here throughout really the 97, 98, and just to be clear, these charts are relative to the broader market, relative to the S&P 500. What you can see is that both communications equipment and telecoms were outperforming the S&P 500, which was really in a bull market at the same time as well. And actually, you can see it, those telecom companies, the spenders, kind of peaked pretty early, Jan 1999, on a relative basis, relative to the S&P 500. And then they started kind of tracking the S&P 500 and started lagging the S&P 500. But those companies that were earning that CapEx spend, so the communication equipment companies, really continued rallying for the next 12 months as their forward earnings expectations were being funded by that CapEx spend. And it was really them topping the market in kind of March 2000 that led to the broader complex selling off. Now, if you overlay that parallel with kind of the Mag 7 or the hyperscalers that are spending cash versus the semiconductors that are earning the cash, well, actually, you can see relative to the S&P 500, the Mag 7 pretty much topped in about September of last year and has actually been lagging the broader S&P 500, which is something that we haven't really seen, barring a little bit of a blip in with the DeepSeek moment, and again in 2022 for really the last sort of 5 to 10 years. So that leadership shift and changes has been quite significant. And it's been the semiconductors that are really benefiting from that spend, but questions are obviously now being asked around how sustainable that is longer term. Diversification is obviously key. If we are in a bubble, here again, just a bit of a parallel to show you how different parts of the market that haven't benefited can perform pretty strongly, even though a bubble might burst. Here I've kind of showed the equal S&P 500 equal weight index, S&P 500 dividend aristocrats index. NASDAQ topped in March of 2000 and sold off dramatically. It was off about 60% by the end of or middle of 2002. Over that period, the equal weight index was up something like 25%. The dividend aristocrats index was up something like 30%. So it's not that you have to be all out of equities. It's about how you build a well-diversified portfolio that's driven by different return drivers to ensure that you can continue generating real returns that aren't underpinned by just one theme going forward. Cognizant of time here, we've kind of touched on this. Globally, valuations aren't as challenging as they are locally. So we're certainly looking at ways of reducing our concentration risk. We're allocating to cheaper parts of our cheaper growth assets where the hurdle for delivery is not so high, and the real return expectations on a 5 to 10 year basis, not over the next 3, 6, or 12 months, because there's a lot of short-termism in markets today, are much better. We're seeing real rates continue to climb. So actually diversification has been a headwind. Real rates now in the US are up at 3%, kind of at the long end. 30-year real rates are up at 3%, kind of matching that quick liquidity spike in 2008, and really are starting to become a real alternative for driving real returns in portfolios. But as those real rates continue to tick up, that defensive part of your portfolio can be a bit of a drag on performance. What's quite interesting is globally we're seeing break-evens and market pricing of break-even really not reflecting any of the elevated inflation risks, either from oil or from the AI build-out here. You can see really well contained on the chart on the right-hand side. What does all of this mean? Higher real rates, more expensive valuations, despite significant increase in equity issuance, debt issuance. We're seeing risk premiums are continuing to compress pretty much everywhere that we look. That means that you're not being paid lots for taking risk at this point in the cycle. And so one needs to think about how much risk you're taking and how much you're being paid for taking those risks, given the assumptions that are embedded. There you can see equity risk premiums on the left-hand side, top left to bottom right. Seeing credit spreads chart on the right-hand side, equally as compressed. So just kind of capping and doing a quick review here. AI build-out is inflationary first before there's any productivity gains or before it becomes inflationary. There's certainly been a change in market leadership. From an S&P 500 perspective, we're seeing the spenders are starting to underperform quite significantly, and the earners are starting to really go exponential. Actually quite interesting, that kind of echoes sort of what happened around previous sort of bubble tops that were driven by capex spending. Index level volatility is significantly compressed, and it's kind of creating this sort of sea of calm, even though we're seeing the large single stock moves underneath that. Real yields continue to tick higher and are becoming a great way to deliver real returns in a portfolio. Equally, they become a higher hurdle for businesses' cost of capital. And we've got the best entry point really for bonds in pretty much the last 25 to 30 years. I mean, a real yield of 3% on US tips, fundamentally it becomes very difficult to argue that that's not the best valuation that we've seen in 25 years. And risk premiums continue to compress wherever we are. So you need to be careful about how much you are paying for earning risk. Here's our long-term capital market assumptions. We've seen some compression really in US equities and emerging market equities, given the quick evolution and the quick change in that part of the market, given how elevated earnings are, how stretched they are compared to kind of long-term sustainable levels there. all defensive asset classes across the board, whether that's SA defensive assets or global defensive assets, are offering really attractive real yields. I mean, certainly not sexy, certainly not the 20, 30, 40% returns. But in an environment, if we do see sort of a bit of a retracement, there are good ways to continue ticking away and earning those real yields that are aligned with our client investment objectives of inflation plus 4 to 5%. SA equity, kind of roughly fairly valued, but I caution obviously that the range and the distribution of outcomes is very wide from here. We could see very strong returns if gold rallies back up to 5,000, 6,000 and beyond. If it retraces back to 3.5 to 3,000, we could see some more pain from SA equity over the shorter term. And what that really means is, in net, at a portfolio level, we are more defensively positioned in our portfolio. We have a lower allocation to growth assets. So through the cycle, we had 70%, we had 65% now. Where is that sitting? Well, we're overweight broader emerging markets. During the quarter, we started rotating away from broad emerging market exposure and started allocating more to China as a market, as we're kind of banking some of those gains from sort of Korea and Taiwan and some of that memory trade. We are concerned around the concentration that a broad emerging market index currently presents, both from an idiosyncratic perspective and a thematic perspective. But we still overweight the broader emerging markets, but with a lower exposure to the broad EM index. SA equities, we're overweight. We need to generate and earn real returns for our portfolios, and those real returns are looking at least fair from an SA equity perspective. Net, we're overweight South African defensive assets. If you add together bonds, linkers, and cash, we're still overweight linkers and underweight nominal bonds, given the relative inflation risk premiums that are priced into nominal bonds here. We're also shorter on a duration spectrum there from a bond perspective. And our big underweight is really to broad developed market equity in the US. We're looking to manage down concentration risk there and drive through more diversification with allocating to strategies like S&P 500 equal weight, dividend aristocrat strategies with much higher earnings visibility through the cycle. And in an environment like today, where an asset class like cash is still giving you real three, it provides a lot of optionality to allocate to asset classes at better entry points when the long-term real return expectations are better, because you're not giving away those real returns. There's not a negative carry impact from holding cash. Globally, we overweight those inflation linkers. We do have quite a large allocation to global bonds. That's been a bit of a headwind from a portfolio perspective, as we've seen those real rates continuing to get up. But as real rates tick up higher, the forward-looking prospect from global bonds is actually materially improved. And given kind of the term premium that's coming back into the global bond market, we are starting to move out on the duration spectrum there. However, we are cognizant that the Rand is a very important diversifier if the SA asset class complex turns over. So we separate out our asset class decision from our currency decision, and we're holding more hard currency in the portfolio currently to ensure that we are focused on diversification. I see we've gone over time now. I've just heard the noon gun go off in the background. One point to just make. It's often at the time that it matters the most that it feels like diversification is a drag on portfolios and not necessary and frustrating. But as we sit today, we're seeing correlations significantly tick up. EM and DM are a tech trade now, an AI trade. We've seen exponential and parabolic moves up. SA is pretty much a gold trade. We can see that those correlations are relatively high. One needs to think about how you can drive broader diversification in portfolios. If what has worked historically, those tailwinds become headwinds, how do you think about generating real returns going forward? And for us, that's something we're really focusing on to ensure that we have embedded sufficient diversification in portfolios and we can consistently deliver real returns for clients through the cycle. So I'm going to have to cut it there and end there as we've gone over time. Unfortunately, I didn't have any opportunities to pick up questions, but we will definitely answer those for you and get back to you. And please do reach out if you want to pick our brain on anything or you have any questions going forward. Thank you so much for joining us. Always appreciate that you take time out of your day to join us, and look forward to speaking to you again in 3 months' time. Good luck out there. Thank you. Bye.